With a volatile start to the stock market in 2026, it's important to evaluate how much risk you're taking on in your portfolio. With the recent conflict in Iran, with oil going from $60 a barrel up to over $120 a barrel, as well as the recent AI scares due to software and AI disruption, it's important to evaluate how much risk is in your portfolio. We've seen oil prices jump as much as 10% in one day, and then there's a decrease in 17% in the price of oil in a different day, which can really drain on the portfolio. Actually, the cost of oil is tied to much more than just one industry. It actually can increase cost for many different companies when it comes to shipping and different types of manufacturing costs. The conflict in Iran also can spook some investors out of the stock market, causing the stock market to decrease. So it's important to evaluate how much risk is in your portfolio, especially during these turbulent times. Based on all the fear and the news headlines that we've been receiving recently, you'd think the stock market is down tremendously. But it's important to reevaluate that the S&P 500 year to date is actually only down about 2%. And if you look a little bit longer, it's actually from its highs only down about 3.5%. It's incredibly important to build your portfolio in a position where you're going to prosper during the up years, like we've had over the last few years, but also have enough safety built in for these types of decreases. Again, it's important to not make, emotional investment choices based on headline news, just because, especially with swings in the oil market and conflicts like this, there's a lot of uncertainty, and we don't know how long these conflicts can change and last, essentially. As I mentioned, we saw a report out of the Energy Department that recently said a tanker was able to come through the Strait of Hormuz, and then less than about 10 to 15 minutes later, the White House actually came ahead and said that that actually did not occur. But that news, over the course of that 15 minutes, actually sent the price of oil futures down more than 17%, which means that basically you need to position your portfolio for the long term, not act on emotional decisions. And this is why clients at A Better Way Financial, over the course of the last 18 months, Frankie, and myself have actually started to systematically take a different approach to risk. Now, a good portion of our clients here at A Better Way Financial are still working, but there are many of you that are actually already retired. And that's why we build the portfolio this way. When there's a down year, such as we've seen so far, it's really important to take income from the safe side. That way, you're allowing yourself time for the stock market to recover. But if you have up years like you've seen in 2024 and 2025, it's important to take money from the stock market side. So the side that's actually at risk. That way you are selling high when the stock market's up, taking income from the stock market side. And when the stock market's down a little bit like it's been in the first quarter, you can take income from the side that has not decreased due to stock market risk. And just a message from Frankie, and myself, and the team here at A Better Way Financial. We're just so incredibly grateful that you've rated us the #1 financial planning company in the Lehigh Valley again, and not only in 2024 but in 2025. So thank you very much for all your support. We really appreciate our community here.